Okay, fam, welcome back. So today we're going to be going over something known as the double dividend strategy and how, if you're a dividend growth investor, you can use this to your advantage. So, with that being said, let's get it. All right, so not going to be talking about crypto in this video, although you guys can see there is quite a bit of green on the table, so that's always a good sign, right? Okay, so first of all, I want to go over what the double dividend strategy is. With something like high yield dividend ETFs like QDTE, XDTE, FEPI, AIPI, YMAX, YMAG, even some of the single stock ETFs that YMAX offers, or even things like YBTC and YETH and whatnot. This strategy doesn't apply to them because, again, those ETFs already have massive payouts. So there's really no need to do a double dividend on that. You can. It's possible you can do it. I can actually show you guys right here. Personally, we're not going to be doing this, but you just have to give me a second. MSTY was up a lot earlier in MSTR, but again, I really don't think MSTY and MSTR are at their peaks yet. I think it's going to be a while before we see the peak. It wouldn't shock me if MSTY's final all-time high was somewhere around $50 to $60 a share. I know that sounds crazy, but I'm just telling it like it is. So this is only 4 days out, but you guys can see very clearly that there are options that are being traded on MSTY. Again, if you have a share price that's lower than 29, then it would make sense to do this because you get paid options premiums plus actual profits. Our share price per share is not that low, unfortunately. So we would have to go with something a little bit higher, like 35 or whatever. But you can see it's an option here. But personally, with because of the fact that they already pay such high dividends, we probably just wouldn't do something like that. So the double dividend strategy is essentially this. Okay, so you take a dividend growth stock, any kind of stock that's a dividend grower that's been paying dividends for a very long time. Ideally, a bigger company would be better, something like Pepsi or trying to think of what else. Realty would probably be a good example. Walmart, dividend growth stocks that pay a decent dividend, that grow their dividends over time, but that you can also do options on. So essentially what the double dividend is a dividend growth stock that pays you dividends that you would obviously have to have 100 shares on to do this, that you can also do cash secured puts and covered calls on. Okay. So on the one hand, you're getting passive income from the dividends. On the other hand, you're getting passive income from the options. So let's go into what that would look like. All right, so I'm going to start here with Pepsi. Just going to use a few examples. I'm not going to go too deep into this, just to kind of give you guys an idea here. This is something that we're taking a look at doing in the future once we have like a significant amount more capital. And I'm talking hundreds of thousands or maybe even millions of dollars. Again, we kind of the general idea we have for our dividend portfolios going into the future is roughly about a third of those in high yield, a third of those in, or I should say high yield, low growth, a third of those in mid yield, mid growth, and a third of those in low yield, high growth. In this case, this would be the low yield, high growth section of that portfolio to basically live off of. So Pepsi is a good example here. I think I would have to go a little bit further out to actually get some decent premiums here. Again, this is one that you can do a weekly on. Of course, you would have to have 100 shares. And if you're doing a covered call, the ideal thing here is that you would want the strike price to be above whatever your current average is. And if you don't have the shares, then ideally you'd want to put on a cash secured. But if you have the money to do it, again, if you have $18,000, but that's 100% of the money that you have, then maybe this isn't the best strategy because, diversity is king, or diversification is king. And I do think Pepsi is a good company, but I would just not own just Pepsi. I'd be looking to have this as like a one of many positions in the portfolio. So you can see here, if I'm going over the deltas, again, this is a very low delta because Pepsi is not really a volatile stock. It's not like Nvidia. Nvidia is like really insane in terms of volatility. So, again, how many days how many times can you put 11 into 30 days? Essentially, roughly about 3. Okay. And again, this at 18 delta, it's very low. So if you already had 100 shares of these, you would essentially be on track to get the dividends. And in between, then you could collect some premiums as a result of this. So basically, you'd be looking at first, you would get $135 a quarter. Okay. Because again, you need 100 shares to get the actual options to do on these. So you get $1.35 per quarter times 100 shares, $135 every quarter. I do the math on this. It's very simple. So 135 divided by 3. Again, they pay on a quarterly basis. You kind of are wanting to look at this on a monthly basis. So $45 a month, roughly thereabouts in dividends. And then you would add another $126 on top of this. This is where that double dividend comes into play for the options. And notice how the options does pay more than dividends. I have said this before. This is the reason why these option-based ETFs always pay more than dividend-paying stocks, usually. Because again, the money comes from the premiums, which are usually much more than what most dividend stocks end up paying. So in terms of returns here, so let's go ahead and calculate this real quick. So I'm going to just say that the total amount we have invested here is $17,500. And if I actually do this, let's say times 3, because we want to do this on a monthly basis, so $513 a month. And again, this is not going to include the price appreciation or dividend raises going into the future. So do keep that in mind. But you can see just based on this alone, you would get almost a 3% rate of return per month. Okay. Per month. That's just in 1 month. So if I times this by 12, the total that you would theoretically make, not including price or dividend raises per year, would be about $6,150. So with options, again, this is the double dividend, not just investing for dividend paying stocks. You would get roughly about a 35% rate of return over the course of 1 year. Now, am I sure that Pepsi is going to be higher in a year from now? Yeah, most likely. I mean, guys, it's Pepsi. Everybody, I don't know, maybe not everybody, but a lot of people out there do drink caffeinated drinks, okay? Whether it's coffee, soda, energy drinks. A lot of people drink that kind of stuff. Okay, just to get back to all-time highs, another 12%. So you could actually throw the 12% on there and say, oh yeah, well, okay, within 12 months it could go up 12%. That's realistic. Okay, I don't think that's unreasonable. That could put this at 47% in 1 year. And again, this is a very low beta, low volatility, very well-established company that's been paying dividends with increases for over 50 years. Okay. As far as I know, it is currently a dividend king. So I'm going to take a look at another one. All right. And this is a popular one that everybody loves. Everybody talks about. Everybody talks about this one. I mean, literally everybody. It's actually quite cheap right now. So if I measure this, and again, I know this video has nothing to do with this, but if I measure it from the current prices, you can see Realty is currently down roughly about looks like roughly about 17% from the previous swing highs. So it's at a pretty steep discount. The other thing I did want to point out here is we have a potential inverse head and shoulders. So you can kind of see it here. I don't know if it's real obvious. This is one of the great benefits of knowing TA is you can kind of understand these things, see them ahead of time, and then kind of allocate or position yourself accordingly. If I were just to do the measure move here, and again, this is just an added bonus for you guys, you can see it wouldn't quite put us back at all-time highs, but roughly about $72. Okay, so Realty is also a dividend growth stock, and this one does actually pay more than Pepsi. So we're going to take a look at the options chain for this. And I actually need to go up here and pull up Realty in here. I think it pays like around 25 cents a month, if I'm not mistaken. Okay, 26 cents a month, whatever. It's pretty close. Okay, so this is not a quarterly one. This is a monthly one, and you can see it's a 5% yield. It's very good. 5% is more than the current inflation rate, although we could all argue that the inflation rate probably is higher than 3%. Like, they're saying it's 3%, but whether it's actually 3% or not, that's debatable. But you can see Realty has raised their dividends for a very, very, very long time. Okay. actually as far back as even through the Great Financial Crisis. So this is a very stable, strong, well-established company. Dividend raises typically seemingly almost every month, it looks like, or every couple of months. Okay, so you got your 5% yield, 25 cents a month, or about $3.15 a year. So let's take a look at the options here. This one does not have options as often, so you may have to do monthly on this one. And again, it's, to each their own. You guys can do what you want to. It's your money, right? But yeah, so for this one, I would go with probably the 65. I would do the 65. That's an 18 delta. That's pretty safe. It gives a little bit of upside here, about $3 per share. If you have 100 shares, that's about a $300 profit. And you would basically have to have 100 shares to do this, okay? So I'm pretty sure Robinhood does not let people do naked covered calls. Call debit spreads is a different story because you have two opposing positions hedged against each other. You're not trying to do one or the other. You're doing both simultaneously. So, both should theoretically cancel themselves out. So there is some kind of protection there. But we're just going to take a look at this, okay? So you get $75 a month in options premium based on the current valuations of the options. And then you get roughly about $26 a month based on every 100 shares. So 26 plus 75, 101. You would have had to put roughly about $6,200 in here in order to get the 100 shares at the current price, which, I mean, the current price of the shares do actually look quite cheap, and it is breaking out of a bullish pattern. So that's pretty much all I can say about that. So 1.6% return on a monthly basis, which again is, I mean, it's not great, but it's, not bad either. I mean, that's still pretty good on a yearly basis. That should be somewhere around 12 to 15%. Oh, my bad. Okay, so it's 20%. So you'd still make roughly about 20% per year. And keep in mind, this does not include price appreciation. If you get that price appreciation, let's just say by the time the end of the year rolls, or 1 year rolls around from now, let's say it's up another 21%, you could tack another 21% onto this. And then you would be, instead of being up 19.5%, you'd be up 40% in one single year. All right, so I'm going to take a look at another example. Let's take a look at something like Bank of America. And I know this one is much smaller. It's a bank. It's well established. They're not going anywhere. Neither is JP Morgan. But we'll take a look at this one because, again, most people don't have like $175 times 100 shares just to be able to go buy Pepsi to do this. So we'll take a look at the one of the banks, for example. So this one has a weekly. You can see it does. All right, so I'm going to go over here again. All right, so we got 26, looks like 26 cents a quarter. Again, they did just offer a dividend raise, so that's always good. So if I were to divide this by 3, I mean, it's only going to be $8 a month. I mean, again, it's not much. So I suppose if you really wanted to make something out of this, maybe aim for like 300 shares. It's quite a bit. I mean, it's 12,000, but a lot of dividend growth investors will concentrate on one position for a long time before they start on the next one. So this is not really that out of the question. And again, for the dividend growth stocks, we'd be looking for about 20 to $30 a month is kind of what we're looking for as a starting point. So assuming that you had 300 shares, you get about $26 a month on this one. Pretty decent yield, 2.5%. Now, in terms of the options, this is where the juice really starts flowing on these things. Okay, so this is a weekly. This is one that you can do on a weekly time frame. And again, so we would do 3 a week with 300 shares, or basically this would come out to about 12 per month. So you get the 26 bucks a month from the actual dividends. Then on top of that, so this times 4, you're going to get $480 a month in options premiums. This does not include price appreciation, so 506. And again, based on Bank of America, we'll pull that one up real quick. You can see it's currently at $42, so we'll just say it's roughly about $12,600 is what the amount would be in here. And then you get 506. So you're talking about a 4% per month return, or roughly about 48% a year. Again, that is almost half of your money back within 1 year, and it's not really that far of a stretch to think Bank of America in 1 year from now could be roughly about 20% higher. So it could be more than 50%. Again, usually when the Fed cuts rates, especially in a non-recession environment, non-recession scenario, which in my opinion, I strongly believe is the case now, and I'm expecting the Fed to conduct their business as such, that's what we should expect is higher prices 12 months from now. So there's one last one I want to look at, and this is an interesting one because this is not actually an individual dividend stock. This is an ETF, so that would be SCHD. Okay. I know this is a very popular one in the community. A lot of people love this one, so we're going to talk about it. And again, I'm not going over. This would have to be a monthly one. As you guys can see, they options are not that common for this, but you can do them on here if you want to. So they do have some for both the CSPs and the CCs. So once again, I'd be looking for probably somewhere around a 30 to 40 delta, because again, 40 delta could actually still be quite safe with a low beta dividend paying stock. So even something like a 30 could be relatively safe. Again, it just depends on how much, what you're willing to give up. You know, do you want more in premiums or do you want more in price appreciation? Which one are you looking for, right? So I go over here to SCHD, and I believe they did just have a 3-to-1 stock split, so I'm not sure how that's going to affect the dividend, but you can see it was 75 cents a month recently, so my guess is if it was going to be 75 cents in the future, it would actually now be 25 cents. But again, it is cheaper to own the shares, so again, if I were just to say, 300 shares times 25 cents, you get $75 a quarter, which again is not much, but when you throw options on top of it, it actually becomes quite a lot. So 25 bucks a quarter. And yeah, SHD is at all-time highs. So am I surprised that they did a stock split? Not really. I mean, all these companies do that. When they get to all-time highs, when the valuations get really expensive, they do stock splits. Okay, Amazon did it, Nvidia did it, Tesla did it. I mean, they've all done it. So it doesn't really shock me. So yeah, this one's sitting at all-time highs. I mean, the stock split makes it more affordable. I don't think there's really much else I can say about this. All right, so if you had 300 shares, whoops, I did not mean to do that. Okay. Because again, we don't have any shares of these currently, so we can't actually do options on it. So you'd basically get about $90 a month in premiums here, plus you would also get the 25. So 115 bucks, and again, this would cost roughly about, looks like I'd say about $8,500 is the investable amount here. So we got 115 divided by 8,500, so 1.35% return over the course of 1 month. Again, if I were just to do this times 12, obviously it becomes a lot more, and your rate of return would be much greater. So 1380. You're looking at, even with something as low yielding as this, you're still looking at around 16% return, which does actually beat the S&P 500. Again, the S&P 500 only yields roughly about 10 to 12% return per year. So some people don't want to do this. They'd rather go with the higher yielding dividend ETFs, diversified ETFs like QDTE and whatnot. But to each their own. It doesn't hurt to have some diversity. And, if you have a large account, this may be something to consider as a way to get exposure to some single stocks. And then you have like some ETFs and maybe some moderate, some business development companies, closed-end funds, master limited partnerships, although typically I think you do get a K1 form with that, which comes directly from the company, which you do have to file with taxes, if I'm not mistaken. Don't quote me on that. Go check with your CPA, but it's one of the reasons why we try to avoid the K1 forms, but some people invest in those too. So anyways, hope you all enjoyed this content. Please like, comment, and subscribe, and I'll see y'all later. Peace.